class. In this recording, I'm going to talk about a number of things, but all of those things that we talk about in this video will be centered around recording transactions and how important this particular role in the functions of accounting and how you can use this information to help you through your course. Transactions are business events. And we all have number of different types of business events in our own personal lives that include the purchase of food, purchase of a phone or utilities, payment of car notes and house payments. All those types of things are transactions. So we need to identify an event, a business event in particular, so that we can determine based on that event whether or not, or not even whether or not we record the transaction, but how we record the transaction. And that process that we are going to go through is analysis of transactions, and is an essential role of being able to accurately understand what's happening within the business. So we're going to talk about the role of transaction analysis. We're going to talk about a lot of things in this chapter, including how to organize information, accumulated information in order to prepare financial statements. So in the previous course, I'm sure you talked about the accounting cycle and all of that. We're going to actually build upon that knowledge, and hopefully you've understood the process sufficiently well that you can analyze transactions, understand the nature of those transactions, and how they are affecting both the assets, liabilities, and equity, and how we are measuring them in specific types of currency. So accounts are affected. How do we know? When we buy something, sometimes it's clear what you're doing, but in the end, you're still analyzing the transaction. You're identifying what exactly have occurred. And then you're asking yourself, we know that a transaction has occurred, but we need to know how to determine what accounts are affected. So using a lot of examples in this textbook, you may be able to utilize that knowledge to help you deduce exactly what's happening in the transaction, and a step further, determine what accounts are affected in that transaction. So in your analysis, think about what's going on. Identify the purpose of that transaction. Identify what's actually happening. What accounts that may very well be impacted by this type of transaction. So we've gone through chart of accounts. We talked about in previous chapters, in your previous course, the different types of accounts, meaning some of assets, which are something that you own and you can use or dispose of. Liabilities or obligations. Then you talk about on the other side of the coin would be your equity. Well, that would be revenue, which is going to be increasing your equity, or your expenses, which is going to decrease your equity. Common stock being another item or an example of equity, and dividend payments that are made to shareholders. So now that we look at these accounts or these headings, we can look at specific accounts within those headings. So we talk about assets. What would be a typical asset? What would be something that an individual or organization would own? Cash is one. They own that. They use that in order to procure more sales or purchases. Another asset is going to be something like inventory. They sell that for revenue. So getting an idea of what specific accounts and how they're grouped is very helpful when you're analyzing transactions, because that's going to really be the two pieces working together. Understanding what a transaction that has occurred and understanding the nature of the accounts and how they're grouped and the examples of each one of those. So when we're talking about this transactions and how do we organize information in such a way that we can accumulate it and evaluate it and report. And ultimately the report's going to be your financial statements. So analyzing what is the transaction that occurred. We purchased inventory. We purchased it for cash, or we purchased it on the expectation to pay it later, or accounts payable. Then we record the transaction. When we record, we are recognizing. This is called the recognition phase of the process. We have to recognize something has occurred. In accounting, recognition means we have transaction has occurred, and by GAAP rules, we have to recognize, we have to record what happened. And the transaction we record is going to be I purchased inventory for cash. So I know, okay, I'm looking at the transaction, and the two things that stick out to me are assets. I utilize my asset, cash, to purchase something I could ultimately use to sell for revenue, inventory. So now we have the analysis of that transaction, and now we have the recording of that transaction. So we're going to increase the asset that we received, which is inventory, and we're going to decrease our asset, which is the cash. So we recorded the entry. But not only are we recording entries, sometimes, and various reasons, we may have to adjust our accounts. And we'll talk about why we adjust accounts and preparing trial balances. And then, and finally, we'll accumulate the information and sort it in such a way that we have the ability to create our financial statements. So a T account looks just like a T. One side is the debit side and one side is the credit. Now, again, we want to make certain that when we're talking about a T account, what is it actually showing? I believe, in my personal belief, a debit, or in this case, a T account, is really a visual of exactly what's happening with a particular account. So up on the top where it says account title or name, that would be cash, for example, or it could be inventory, for example. And what this does in this learning activity is gives you a picture of exactly the type of transactions that are affecting the account, whether it be increasing the account or decreasing the account. And this gives you the ability to be able to determine what the ending balance is. So it's quite important to understand the nature of why we use T accounts, particularly in a case of an educational environment. Why do we use T accounts? What purpose does it serve? And in reality, in the real world, we never really use T accounts. This is more an academic exercise that allows us to be able to visualize the interactions between various transactions and how they affect the ending balance of a specific account. So it is most certainly an exercise in classroom setting, which you never see in the real world. And why? Because we use accounting systems like QuickBooks and Peachtree and Great Plains in order to analyze and accumulate information. But this is a very, very good tool for us because we need to understand and utilize our knowledge and apply it. And this is a good way to see exactly what's happening with individual accounts and how do we know that at the end of all the transactions for the month, our cash ending balance is X dollars. If we put all of the transactions in a T account, we can visually see all of the ins, the debits, or the outs, the credits that make up this ending balance. So now, as I move around a little bit, I want to make certain we can see rules about when to use debits and credits. Now, remember, we have to record transactions, and in generally accepted accounting principles, we have the recognition rule, we have the revenue recognition rule, and we have the expense recognition rule. What happens when we have to recognize an event has occurred? Well, we have to recognize our revenue because we earn revenue because we completed the sale. The sale of a product or service was complete. Doesn't matter if we receive money for it or not. We have to recognize it when the earnings process is complete. That's our rule. So have the earning and process has been completed for a particular customer? If it's no, you don't recognize it. Well, we received cash. Well, that means that there's an obligation to perform that service or provide that product. In which case you have to show the transaction has occurred, but you don't recognize the revenue part of it. You recognize revenue when you've completed the work. So the rules about debits and credits. The rules is this. We want to increase our assets or our expenses. Now remember, our assets are things that we own. Our expenses is going to be a reduction in equity. Equity goes down when we have an expense. We incur an expense, right? So expenses are going to be debited. Why? Because they are decreases in equities. Very, very important to note that. People will say, why do you have an expense? Well, expense is a decrease in equity. If you think about the accounting equation, assets equal to liabilities plus equity, well, where does expenses and revenues fit in all of this? Well, revenues and expenses fit into the equity side of things because equity is going to be your retained earnings. It's going to be your common stock. It's going to be your paid-in capital, and it's going to be your dividends. So we have to consider when we incur an expense, we're reducing equity. When you reduce equity, you have to debit it. And so increases to assets, it's going to be debited. Expenses, when you have expenses and they have been incurred, they're going to be going up. You're going to debit them because you debit expenses to reduce overall equity. Losses, same thing. Losses is very much like an expense. It's an other expense, and it's going to be reducing equity. And again, it's debited. Dividends is the same thing. Dividends reduce retained earnings. Retained earnings is equity. So when you go through your textbook and you're reading through, think about it in those lines. If we're making an increase, if we're increasing our expenses or our losses or our dividends or even assets, we know that we're going to debit. It doesn't matter what the naming convention is. If it's an expense and it's going to be increased, we're going to debit it. It's simple as that. So my suggestion would be to know what types of accounts are specific to expenses, are specific to assets, are specific to dividends. Know the type of transaction so when you see them on site, you know it has occurred, you know what you need to do. Same thing with liabilities. Liabilities, it's an obligation to pay someone something. You owe them something. Chances are it's an asset. Asset for the most part could be, and it almost always is, cash. They did something for you. They provided you utility service. They provided you telephone service. They provided something to you. You received something, some kind of asset. You incurred something. You were able to receive a benefit of something, but you didn't pay for it yet. That's an obligation. So you got to give them something in return for what they've given you. In that case, it's going to be cash. So the liability is set up to show that you have an obligation to provide someone with an asset. They have a claim against your asset. That's essentially what a liability is. Equity on the other side is going to be increased with liabilities. Again, we're looking at the T account. I'm going to go back to this previous screen here. If this was an equity account, and I will use retained earnings as an example of an equity account, you'll notice that equity accounts were going to always increase, get bigger with credits, and we reduce our equity accounts with debits. The opposite is true with expenses and with assets. So just visualize. Again, it's all about really visualizing. I think the most important way to understand this is to visualize exactly what's happening. And when we go back and we want to visualize how these rules that we're presenting here, how they are to be applied, it will be important for you to look at the T account, because that provides an excellent visual of exactly what's happening when you increase an asset or an expense, or exactly what's happening when you decrease an asset or an expense, and vice versa. So in this case, I purchased assets. I purchased this asset called inventory, but I did not pay for it in cash. They gave me 30 days to pay. So how do I deal with that? I have to record the transaction. An event has occurred. Was there a change in cash? No, but still I have to record it. So I have to show that I'm increasing my inventory, because that asset, to me, I can use that. Inventory could be a product that you ultimately will resell, or maybe an inventory item that you will convert to something, then ultimately sell. Regardless, it's an asset to you that you can use. But since I did not pay for it yet, I have an obligation to pay it at some point. And operational obligations are, generally speaking, going to be an accounts payable item. These are all about the operations, the day-to-day operations of that organization. It's not a note where you sign an agreement to pay it back over a period of time with the interest rate attached to it. This is generally a very, very short-term obligation to pay in the normal operating course of business, accounts payable. So we increase our asset with a debit. We increase our liability with a credit, and we see with this entry here that both our debit and our credits equal. Again, balancing our entry. So, journal entries examples. This slide is just giving you, these are the type of transactions you're going to see. You're going to see the payment for insurance. You're going to be seeing when you borrow money from the bank to buy an asset, in this case a truck. Collected money from a customer, in cash, of course. Paid for inventory, whether it be inventory for retail resale, or inventory item for a customer, a specific customer. So these are the different types of transactions and the entries that you may have to record. And the most important part is when you're analyzing transactions, this is kind of what you'll have to think about. What's happening? Or what are the accounts that are affected? How are these accounts increased and how are these accounts decreased? So updating your T accounts. Again, within this project that we're going to be giving you, you're going to be analyzing many different types of transactions, most of which are repetitive or recurring, because when you're talking about a business and its daily activities, a lot of times the transactions are repetitive. Main thing that changes possibly might be the amount might change. But in the end, standard entries that occur monthly or weekly are going to be in your project. You're going to see them a lot. So it's kind of important to kind of get an idea of the very, very general transactions you would normally see, which examples were in the previous slide. And as I mentioned before, using T accounts is important because it does give you a really good way to visualize exactly what the impact of various transactions have on a specific account. And it does explain how you arrived at this ending balance, which you will ultimately report to a trial balance, which will ultimately convert to a set of financial statements, an income statement, a balance sheet, a statement of retained earnings. So regular entries are going to be of this again normal operational transactions. Period. Adjusting entries. Now remember, we create adjusting entries when we have to recognize something that has not been recorded. We have to match the use of an asset. Depreciation is one example of that. So again, we record our transactions in normal course of business. At the end of a period when we're compiling all of this data and we're ready to create our financial statements, there are various accounts that may very well need to be adjusted. Why they need to be adjusted? Because there may be transactions that have been incurred, expenses that have been incurred and not recorded. There may be adjustments for errors. There may be revenue that needs to be recognized, even if the cash is not received. Meaning you recorded, you actually completed the work for your client. They're happy with your work, but they've yet to pay you and you've yet to bill them. You have to make an adjusting entry for that. You have to adjust to the books to reflect the actual or the revenue that you received during the period. So that's really the main reasons why there are adjusting entries. Why they're the type of adjusting entries, again on this slide is just giving you an example. Expenses that have been used or incurred but not paid or recorded. Very important. Employees who have performed the work that have not been paid and the entry has not been recorded. Increases in the expense or decreases in or increases in liabilities. If there has been a change in your liabilities, chances are you have an expense to deal with or cash to deal with. We are accruing revenues and expenses. We're accruing them and recording them on our books. A revenue that you've earned and have not received. Again, the most important thing with the accruals is you haven't recorded them. You have to show that you've earned the revenue. Why? Because the accrual basis of accounting, the matching principle, we have to consider the recognition of revenues when it's earned, not necessarily when revenues that is received in cash. Now, I'm not saying you don't record it when you receive it in cash, but don't let a cash-based transaction preclude you from recording the revenue that you've earned 2 months ago, and you just got your money from your client 2 months later. No, we want to record the money when the revenue process has been complete. When you had use of an asset, you've used that asset. You've used it, not all completely, but you've used it. You have to show that you've used it. So that expense is going to be for use of an asset. Depreciation is an example of that. Supplies that you purchase. You purchased supplies, office supplies, and you paid $10,000. Well, you purchased them and that's an asset to you, but now you've used it. So now I only have $100 of my supplies left over. I can rightfully assume that the assets that I purchased, the office supplies, now have been used, and we have to show that as an expense. Office supplies expense. Deferrals on other type of transactions. Again, if someone paid you for services that you have yet to render, yes, you need to show that unearned revenue. If, for example, you have a case where you have pay for your insurance. You pay it 12 months in advance. What do? Well, you got to show that you have to recognize the amount of insurance that you've used. Because a prepaid insurance is, I paid for a benefit that I have yet to take advantage of. I have not used the insurance yet. So it's an asset to me. It is a future benefit, an asset. But once I've used the asset, however, I have to show that it's been used up. Financial statements are prepared using adjusted accounts in the T accounts. Now, again, I suggest creating your journal entries, transferring those entries to T accounts, getting those ending balances to agree, and then transferring that to a trial balance. A trial balance is a listing of accounts and their balances in debit and credit format. It is for the sole purpose of assisting you and I of preparing financial statements. When you're using accounting software like QuickBooks and you put all these transactions in, you can create your trial balance with the push of a button. In this class, however, it's kind of important to go through the mechanics of actually preparing the trial balance, actually preparing the T accounts, because you can actually see and understand what the automated system is actually doing. So the financial statements is going to be based on the adjusted trial balance. You're going to make certain that your entries, your journal entries are done, and then you're going to complete your income statement first. Then you're going to do your statement of equity, and then lastly, you're going to do your balance sheet. Now, some classes may require a statement of cash flows, but I think the most important thing here in this class is preparing the income statement, preparing the statement of equity and the balance sheet, and understanding how and what the purpose is of a statement of cash flows. I don't believe you'll be asked to prepare a statement of cash flows here, but I do think it's important to know what it is and what its purpose is, in addition to understanding the purpose of the income statement and purpose of the balance sheet and the statement of equity. So when you have prepared your financial statements, it is important to note that the financial statements means that your accounting period is essentially complete. There are no other entries that need to be made. You are now able to close your accounts. Closing your accounts could very well be closing the temporary accounts and accounts that are normally zeroed out and moved to retained earnings. And they include dividends, they include expenses, and they include revenues. And again, using accounting software, this is all done automatically, but my opinion is to understand exactly how those accounting systems create these types of transactions, what it's doing, and why it's doing it. So using the project that we're going to be working on in this class, you can see exactly what's happening behind the scenes using an accounting software, because we'll be doing all of those types of transactions manually. This chapter is a very, very fundamental one, but it's not a difficult one, because when you think about it from a logical perspective and you think about how everyday life, you and I, we're constantly dealing with transactions, and we're analyzing those transactions in our minds because we know exactly what's happening. We know that we had our utilities, we had our lights and our gas bill, our lights and our gas. So if we use that, I know it's an expense to me. So I'm going to say my utilities expense, and I'm going to say my cash because I wrote a check to pay for my utility bill. So if you can use kind of the thinking process about your own personal finance, it's very, very similar to what a business would be thinking about and how they're analyzing their own transaction. I mean, not all of our transactions have a corresponding side to it where a business would do it, but it does give you an idea of their similarities between the two. My hope in this particular video is to help you understand how easy it is to analyze transactions, how common these transactions are, and what they mean, and allowing you to be able to look at them, analyze them appropriately, and have a very good idea of the various accounts that are specific to a transaction to help you create these journal entries, T accounts, and then ultimately adjust your accounts to prepare trial balance and the financial statements. Thank you so much for your time and attention, and I will be talking to you in the next video.